What are our thoughts on Toronto pre-cons? I'll be upfront. We are long-term investors and we choose safer investments with the highest, most stable long-term returns, and typically that's in the freehold space in Toronto. But many new investors do consider pre-cons, and one popular argument is that it's scary to put too much money in one bigger property, and it's an easier first step to start smaller with a pre-con. Another thing that attracts new investors is the passive nature of pre-cons in the beginning, without having to worry about renters, operating expenses, or mortgage payments. And even after taking possession, investors find condos still easier to manage than houses. Finally, they hear stories of huge pre-con gains at closing, so they can refinance right away without doing anything and enter into another investment right away. In this video, let's dive in and learn more about pre-cons in Toronto, how returns really compare, the good things about pre-cons, and some other things to consider before you make your decision about what to invest in. If you enjoy content like this, please give us a thumbs up now, and don't forget to subscribe to our channel so you don't miss other content like this made specifically for real estate investors in Toronto. Let's backtrack and recap what a pre-con is. A pre-con, short for pre-construction home, means that you're agreeing to buy a house or a condo either before construction has started or before it's finished, and the completion date is typically a few years down the road. Unlike a resale property where you need to come up with the entire down payment in 30 to 90 days, you can pay for the deposit over a longer period in a pre-con up to completion. You don't own the house until completion, so you also don't need to worry about finding tenants, managing the property, or paying for your mortgage or any other expenses until further down the road. As you can see, the uniqueness of pre-cons really happens before completion, and after that, it just performs like a resale property. In a resale rental property, your returns come from your rent minus operating expenses minus your mortgage interest plus your property's appreciation. In a pre-con before completion, your returns come entirely from appreciation. Most pre-cons are condos, so you really need to understand what's going on in the Toronto condo market. And in reality, it has more ups and downs than Toronto freeholds. The reason pre-cons have been getting so much buzz in recent years is because of how amazing they've done over recent years. If you look at the one-bedroom condo price history, we can get a better picture of this. Between 2015 to 2020, one-bedroom condo prices went up from $345,000 to $600,000, and that translates to an impressive growth of 11.7% per year. But then, if you go back to 2010 to 2015, you'll realize that it's not the case all the time. Over that 5-year period, one-bedroom condos only went up 2.5% per year, going from $305,000 to $345,000. Now, here's another thing. You'll find that the price of pre-cons is typically higher than a resale property at the same time because developers also factor in appreciation in pricing pre-cons. Pre-con buyers are able to make money when actual appreciation is higher than the priced-in appreciation set by the builders. For example, if builders factor in 3% annual appreciation in their pricing, but actual appreciation is 5% per year, you'll gain 2% from the difference per year, and at 4 times leverage, this means you'll be making 8% per year during that pre-con stage. If actual appreciation is 10%, then your appreciation differential is 7%, and that at 4 times leverage, you'll be making 28% per year. On the other hand, if appreciation is actually 2.5% per year, then you lose 0.5%, and at 4 times leverage, you'll be losing 2% per year during that pre-con stage instead. So as you can see, pre-cons are much higher risk because your returns during that pre-con stage is solely based on the market price of condos on completion. Now, besides the unknown appreciation factor, the known part that you will lose out on is the rental income, which is the other part of the more stable real estate investment equation until completion. If you're buying a condo, you might run into slightly negative cash flows, but for the most part, your renters are helping you build equity for your property. And for freeholds, you're likely in the positive cash flow territory, so you benefit from both equity gain and cash flows on a monthly basis. Let's make things more concrete with actual numbers. For a resale condo, assuming the same 5% appreciation per year, you won't be making 8% per year as in a pre-con, but rather 5% annual appreciation plus 2.5% roughly in annual net rent minus 2% interest. And then when you add all of them together at 4 times leverage, this equals to 22% per year. Now, assuming you own a freehold instead, at the same rate of appreciation, you'll get higher gross rents and slightly lower expenses and maintenance fees. So you're looking at 5% annual appreciation plus around 4% in annual net rents minus around 2% in interest at 4 times leverage, and this equals to around 28% per year. Many freeholds are old, and if you put in renovations yourself, you can also get a one-time bump in value add appreciation on top of that as well. So as you can see from a number standpoint, resale properties in a typical market are way more stable and have much better returns compared to pre-cons. But having said that, it's definitely less passive. And we'll be fair, and here are some things that we think pre-cons are good for. The main one is that it gives you time to save up money for your investment, so you don't have to come up with all of the money up front. The deposit is paid over a longer period of time. And even though you don't get the value add appreciation, pre-cons also let you make more design decisions by choosing finishes and possibly even room layouts. There's good and there's bad. Besides more volatile returns, there are some other things that you do need to keep in mind when you're considering pre-cons. The big one is construction risk. If you choose the reputable developers, most of the time construction will go through, but the risk of delays is still really real. And recently, with construction prices going up, another thing that's been happening is that builders might ask you for top-ups to your purchase price to cover the higher cost of building. Buying a new build also has extra costs that don't exist with resale properties, like occupancy costs and HST for new builds. Note that if you are owner occupying the unit, there will be a good chunk of HST rebates, but investors typically have to fork out the HST upfront and get a smaller portion back at a later date. Finally, if you do need to liquidate before completion, it might be harder. Some builders restrict you from doing that. Other builders enforce a higher assignment cost if you want to pass your contract to someone else. And sometimes assignment contracts are just typically harder to sell, especially if the builder is still releasing units themselves. After it's built, your pre-con will act just like a resale property, and then it becomes more of a condo versus house argument, which we do have another detailed video for. In general, condos are newer, so you'll have less issues, but in exchange, you'll have lower absolute returns, lower ROI, less capital, more volatile prices, and no value add. So refinancing to grow your portfolio will be slower than with freeholds. So after hearing all of this, do we recommend pre-cons for our clients? To be honest, it actually all comes down to your requirements and preferences. If someone doesn't have enough capital but wants to get started with real estate investing, pre-cons are a very good option. Remember, not all pre-cons are condos. There are pre-con towns and pre-con freeholds, and these generally do have better rent yields, lower expenses, and more stable appreciation. When you work with us, we take the time to understand your preferences and help you choose the best option where the numbers make the most sense. If you do have sufficient capital for freeholds and pre-cons, but you do like the passive nature of pre-cons, we can help you solve that headache with our leasing and property management teams. Even after you factor in these extra costs on a freehold, you'll likely still be in positive cash flow territory, and you can still benefit from cash flows and equity that you don't get with pre-cons and even condos. If you want to have a chat to talk more about your investment needs and goals, we're ready for you. You can reach out to us by heading to the link I'll put in the description below. Don't forget to give this video a thumbs up, and if you want to hear from us more regularly, look for us on Facebook, Instagram, or LinkedIn. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye-bye.